The real estate market has been a lot slower over the spring and summer, and it's finally heating up. But this time, it's not the same as what we saw at the start of the year. Right now, there's a lot more moving parts in the equation. First, there's a lot more price sensitivity because we've already gone up double digits in most markets this year already. Second, a recovering economy means that we're expecting interest rates to move up sometime next year. And third, along with a recovering economy means rents might start to change up again. So the big question now is, how will all these changing factors actually come together and steer the real estate market moving forward? Now, the real estate market is actually made up of various submarkets that all behave somewhat differently. Even within the GTA, the suburbs, Toronto condos, and Toronto freeholds all moved in different directions over the pandemic, and I suspect that this diverging trend will continue. So in this video, I'll focus on these three specific markets and talk about where things might be headed given all of our moving parts. Hopefully, you'll be able to take this information to make better decisions as a real estate investor. If you like content like this, please give us a thumbs up and don't forget to subscribe to our channel so you see more videos like this made specifically for real estate investors in Toronto. If you're choosing what to invest in, realistically, you're choosing the best option out of what's out there. And right now, real estate continues to outshine the rest. In terms of stocks, inflation and supply chain concerns continue to dampen recovery stocks. For growth stocks, interest rate concerns are now lowering the current stock prices, and overall, there's just much lower upside potential in stocks compared to a year ago. Bond yields are still super low, so even if you're purely looking at yields, rent yields still perform better. So on a relative basis, real estate looks like a pretty attractive option from an appreciation and rental income perspective, and even better after leverage. So this is why we continue to see steady interest from new and returning real estate investors. Having said this, the overall real estate market did take a breather for most of Q2 and Q3 this year. And after getting settled in after the summer, investors are now becoming more active again. At the current moment, real estate demand is very strong, but supply still hasn't come back at the same pace. So what we're left with is more buying competition, causing real estate prices to soar again. But unlike what happened in Q1 this year, there is one prominent theme this time around that is significantly different, and I'll walk through this a little bit more so you can see it more clearly. Since the start of the pandemic, real estate prices have been climbing. And this was actually okay because interest rates were dropping and the two end up canceling each other out. In other words, it was okay up to a certain point. Then beyond that point, prices continued to climb and now there's no more room for interest rates to go down. In fact, rates are expected to head up sometime next year. So now we're in a situation where any upward movements in interest rates or upward movements in prices will actually negatively impact a homeowner's holding power. And so a real estate market's holding power will be the biggest factor that might steer prices one way or another in the short to medium term. Let's look at the GTA suburb market first because it's an easier market to dissect, with the market mainly dominated by end user buyers. So when it comes to holding power, there's one less variable of rental income that comes into play when analyzing the market. As a whole, the GTA suburbs has seen the best run since the start of the pandemic. People didn't need to live in the core and wanted to take advantage of low interest rates to buy their first house, and so they flocked to the suburbs. As a result, real estate prices in the suburbs jumped 43% between February 2020 to September 2021, which is insane. When it comes to carrying costs for end user homeowners, their biggest cost is their mortgage payment, which can vary based on real estate prices and their mortgage rate. So let's see how holding power has changed in one of the GTA suburbs, Oshawa, for example. In February of 2020, average detached home prices were $625,000. Mortgage rates were 2.5%, which means homeowners would pay $2,000 each month in mortgage payments. Then the pandemic happened and interest rates dropped to 1.6%. And at this point in October of last year, Oshawa's average prices rose 10%. Lower rates canceled out with higher prices, so their monthly mortgage payment was still around $2,000, which means there was no change to holding power. Obviously, things did not stop there. Oshawa's property prices continued to go up, and right now it's at $930,000, and that's almost a 50% increase since the start of COVID. This takes the monthly mortgage from $2,000 to $2,600, and that means homeowners are forking out an extra $600 each month, which is definitely a lot harder to carry compared to before. And now we're in another wave up again because we're hearing talks about rate hikes again. So now we have another group of home buyers, possibly the last, who might still want to take advantage of lower interest rates to get into a home. With the momentum that we've been seeing recently, combined with a lack of inventory, it's very possible to see another big leap here because end user buyers tend to act more emotionally and overshoot on prices. If real estate prices go up by another 10%, mortgage payments will be close to $2,900, which is almost 50% more than what buyers were paying pre-pandemic. Realistically, that's really stretching finances way too thin for the typical suburban end user buyer. And when they realize that, we might end up seeing holding power start to let go, which might lead to our first pullback in suburb prices until mortgage payments normalize back to where they were before the latest jump. And then we have a recovering economy, which may take buyer demand in these suburbs lower as it becomes less attractive to live further away from the core. The second part of a recovering economy is interest rate hikes, which will put more pressure on the already thin holding power. Higher mortgage rates will bump up mortgage payments, which might be the next catalyst for the second round of pullback in suburb prices. As a reference, each 25 basis points increase in interest rates will mean that property prices will need to come down by 3% in order for mortgage payments to remain at the same level. Let's move on to Toronto condos, which is the complete opposite of the suburbs. Instead of being dominated by end users, Toronto condos are driven by investors. So instead of just looking at mortgage payments, it'd be more accurate to look at the net cash flow situation, which takes into account rents, prices, and interest rates. And when you do this, you can see that before the pandemic, an average Toronto condo was around $725,000, and it could be rented out for around $2,700 per month. After operating expenses and your mortgage payments, you would have to take out an extra $300 out of pocket each month to hang onto your condo investment. And that was something that condo investors were okay with. Then the pandemic caused condos in Toronto to sit empty. No rents means cash flows went from negative $300 to negative $3,000. The end result was that the landlords had to drop rents by around 20%, and some others were forced to sell, so condo prices also dropped by 15% at their lowest price last year. The upside is that rents recovered 5% over the summer because of more rental demand from students coming back to school, immigration opening up again, and some workers heading back to work, and there's more expected upside potential for rental recovery. Because of this rosier forecast, condo prices also recovered, and right now, condos are sitting close to prices seen right before COVID started. At the moment, condo rents are still lower than the peak at $2,400 for the average condo, but interest rates are also lower at 1.6% compared to the higher 2.5% pre-pandemic. So the two cancel out again, and cash flows are sitting at a negative $400 a month, which is still manageable for most condo investors. Another important factor that's different is that investors are less emotional with their buying, especially after what we've went through with condos during COVID. So relative to the suburbs, we expect less overshooting of prices in Toronto condos and price movements to follow more closely with rent growth. As you can see from this chart, if rents go up by 10%, then condo prices can go up by a similar 10%, and cash flows will stay more or less the same at negative $400 per month. If condo rents recover completely, going up 15%, then condos can comfortably go up by a similar 15%, and cash flows will still stay more or less the same. The second thing to monitor in the Toronto condo market would be interest rate movements, which will limit condo price growth when they do go up. This doesn't necessarily mean condo prices will go down because rents are still climbing upwards when things recover. However, when rates start to hike, condo price growth will start to climb slower than rent growth. Remember from before, a 25 basis point increase will mean property prices will need to come down by 3% for mortgage payments to remain the same. So, as an example, if mortgage rates go up by 25 basis points and rents do go up by 10% as well, then property prices might only go up by 7%. Compared to the suburbs, Toronto condos will actually see less violent swings and less downward risk. Instead, we expect slower, more calculated price increases in the Toronto condo market, which might be suppressed by upcoming rate hikes. Finally, let's see where the freehold market in Toronto might be headed, with demand being more of a mixed bag of end users and investors. But having said that, end user markets in Toronto have very few investors because rent yields just don't make sense in those areas. At the same time, you also don't see a lot of end users in investor-heavy areas because they're less family-oriented. So, assuming that most of us watching are investors, I'll laser focus into the investor freehold market in Toronto. In terms of cash flows, pre-pandemic, you can get a starter freehold in Toronto at around $850,000. Then if you split it into 2 units, the upper can get around $3,000 in rents and the lower can get around $1,600 in rents, so you can get a combined monthly rent of $4,600 per month. After operating expenses and your mortgage payment at 2.5%, Toronto freeholds would be positive cash flowing at an amazing $1,000 per month. In the suburb market, we saw the first surge at this point in October of last year, but Toronto freehold prices were still more or less unchanged at this point last year. Freehold rents were down 10% at this point, but then this was offset by lower interest rates, so the net result was cash flows weren't much changed and they were still cash flowing positive around $1,000 per month. Then we know that everything shot up in Q1, followed by a lull in Q2 and Q3, so now prices are just up 15%, which isn't nearly as crazy as what we saw in the suburbs over the past 2 years. This takes starter freehold prices up to $1 million in Toronto, and therefore cash flows are now sitting at a lower $450 per month. Cash flows are definitely compressing, but the more important thing to note is that they are still cash flowing positive, so holding power is still fine. I talk to many new investors, and sometimes investors tell me that they don't care for cash flows. Now, it's true that you should look at the complete picture, including appreciation, but if you're looking at Toronto houses versus Toronto condos, you'll find that they have similar long-term appreciation, but houses have better cash flows, which means houses have better total returns as a whole. What's more is that cash flow becomes that submarket safety buffer in case things turn south. Choosing markets with better cash flows will ultimately mean stronger holding power in a more stable, growing real estate market. Right now, the supply of Toronto freeholds is also tight and demand is also strong, so we do expect another wave up on the freehold side too. Given our safety buffer, if rents and interest rates don't change, prices can still go up by another 15% before cash flows turn negative for investors. Another thing to remember is that when it comes to investments, there's minimal attachment to a home, and if the price becomes attractive enough and cash flows become less attractive, long-term investors might end up cashing out earlier than expected and then re-enter when things normalize. So if that happens, we might end up seeing more supply come onto the market, which might slow things down on the freehold side as well. Finally, unlike the suburbs where rents didn't change much, Toronto freehold rents are still down 10%, which means there is upside potential for cash flows here as well. If rents bounce back by the full 10%, then Toronto freehold prices can go up by another 15% and maintain the same cash flow levels. Then, if you add in a 25 basis point rate hike to the mix, Toronto freehold prices will get limited, but they can still go up by 12%. Hopefully from this video, I showed you how holding power will become a very prominent theme moving forward and will likely be a key driver in real estate prices. What this means is that markets that have the weakest holding power, which in my opinion is the suburb end user market in the GTA, will likely be the first market to peak and will be the first to be at risk of a downward adjustment. And even after that first adjustment, The suburbs will still be more vulnerable than other markets and may continue to correct downwards once interest rates start to hike. Toronto condos have more going for them with further expected rent increases, and they've also seen the slowest growth so far, which gives them more room for price increases. But because condo investors are already cash flowing negative, price growth can be more limited by rate hikes. Out of all three markets, it's clear that Toronto freeholds have the lowest risk from a holding power perspective with a positive cash flow buffer. And there's also good things going for this market as well. Rents still have room to go up, which can further bump up property prices. And in the long run, a lack of land for houses in Toronto also means this market is fundamentally stronger than the rest when new housing supply gets built in the suburbs or more condos get constructed. Toronto freeholds have the best historical returns, is the most stable market, and is most likely to reap the best appreciation moving forward, and of course, our favorite choice. But if you can't afford it and wonder if you should wait and see how things pan out in the Toronto condo market, just remember that it's really hard to time the market and catch the lows because they don't really last long. Chances are you might be able to snatch a couple % discount on the way back up, and that's a big maybe because we don't expect condos to come down that much. So instead of timing the market, it's always best to just start investing in real estate when you're ready. This way, you'll be able to start collecting rental income immediately instead of waiting for an indefinite period of time, and you'll most likely be better off this way. We are big believers in investing in freehold houses in Toronto, and if you do want to chat more about this, we're ready for you. We can look at your requirements and preferences and then match you up with the best investment property that fits your needs. We're an end-to-end brokerage, so after we help you buy it, our team also provides renovations guidance, leasing, and property management if you need it. So just connect with us to learn more about our services by heading to the link in the description below. Don't forget to give this video a thumbs up and look for us on Facebook, Instagram, or LinkedIn to hear from us more regularly. I wish you all the best in your real estate investing journey. Thanks so much for watching, and I'll see you in the next video. Bye.